IBC. What does that mean? And how does it work? It means the infinite banking concepts. And by definition, the infinite banking concepts is a process of you taking back the banking functions in your life. Now, I've seen this explained a lot of different ways. And when it's just talked through, it's difficult. So what I'm going to do today is attempt to draw out the infinite banking concept and explain it in literally a 5th grade level. A level that my daughter Vivi can look at, watch, and say, Daddy, BYOB. She's already doing that at 3, but we got her a little ahead of the curve. But I want you to understand this at a 5th grade level. So let's dive in. And right now, I'd like to ask you to like and subscribe. Whoops. And while you do that, click the subscribe button, and also there's a little bell up top. We're just gonna go with that. And, anyway, smash the bell. The infinite banking concepts explained. I like to call this BYOB. Be your own bank. So now all of you have an income. And your income comes from one of 4 different places. You probably got yourself a JOB. Some say that's just over broke. Maybe you got yourself a business and you got income from your business. Maybe you're receiving a pension or some type of retirement or an inheritance. All of that money can come to you in various different durations. It can come monthly, bi-weekly, weekly, as in paychecks, but where does that money go when you get it? Well, the chances of your money going anywhere other than someone else's bank are minimal. So if we were trying to take back control of our money, how would we go about controlling our wealth? Because when you get your money, only 4 different things happen to it. Number 1, you save it in someone else's bank. Maybe you put it into a brokerage account. Maybe you put it into a money market account, but you save money. Number 2, some of you actually invest that money through 401ks, stocks, mutual funds, ETFs, Bitcoin, anything that you know, like, and understand that you invest in. Now, we all understand number 3, and that is we spend money. We spend money on things like diapers and going out and dinner and Netflix and all those. So your money that came in on the other side, your income, goes out the door in spending. And number 4, one of the most important things we do with our wealth is we give it. We give it to charities. We do charitable giving and all sorts of stuff around that. But what if before you save your money, before you invest your money, you were to just change one thing? What if we moved that money to a place where you completely control everything? Oh yeah. This is where we want to put your name on the bank. BYOB, or just insert your name right there. Now, let's talk a little bit about your bank. How does it differ than their bank? Well, first, your bank pays you guaranteed interest on all the money you put into it. Number 2, your bank pays you dividends each and every single year, because why not? Number 3, your bank pays you compounding interest on an uninterrupted basis, meaning you can put money in your bank and then still use that money without interrupting the interest and dividends you earned on the initial deposits. Now, what are some of the pluses to your bank, and why should you consider creating your own private banking system as I'm showing you? Well, over here, you've got 0% market loss. You can't lose money because your bank, like I said before, pays you guaranteed interest. That interest and dividends that you earn also grows tax-free if your bank is set up properly. Your bank would allow you to leverage the money in there because it is guaranteed. Therefore, you could leverage this to get loans and lines of credit and all sorts of other things. It could be collaterally assigned. Your money inside your bank is protected from judgments and liens in almost all states. It also provides a legacy. So if you have people that you love, your beneficiaries, your family, Your bank provides an instant legacy, and your bank allows you to fully control all of it. So let's move into your own private banking system, because doesn't that all make sense? And since we have created our own banking system and we get all these benefits, well then after the money goes here first, what will happen is now we can go from our banking system back up to the places that money goes to work. And this enables you to control 100% the flow of your money, which I'll show you next. But seeing as though we changed where the money went first and we put it into your bank, so this is the first place, and then once it's in your bank, what we want to do is we want to move that money back over to places that you control, where we can save money, invest money, spend money, and give to charities. Like I mentioned before, the goal here is for you to become your own bank. And by changing where your money goes first, you're going to put it into a machine. We're going to call it your bank for now. And then what we're going to do is we're going to make loans from your bank, and then we're going to clear those loans through their bank. Hence, in the middle, segregated account. What we're going to do is we're then going to lend that money over to take advantage of opportunities. What are those opportunities? Well, you can use that money to buy cars, you can use it to buy houses and real estate, you can invest in real estate, you can do private loans, you can pay down debt, you can invest that money in things you know, like, and understand, like stocks and ETFs and Bitcoin. All these opportunities are going to earn you some type of interest, rent, and gains. We'll call that profit, but hold on. When we make that interest, rent, gains, profits, what that money is going to do is it's not going to go back into their bank. We want that money to go back into our bank. So as you can see, we're going to draw a little arrow going back up to your bank. So the money starts in your bank, goes over to take advantage of opportunities, and then when the opportunities earn you interest, gains, rent, whatever it is, that money goes back into your bank. You fully control the entire process. But the most important thing is, when you take the money out of your bank, you are going to take it as a loan. Why? Well, because you would take a loan from anyone else's bank for most of these things, like cars and trucks and real estate. So why wouldn't you take a loan from your bank? By taking a loan from your bank, your money never stops earning compound interest. It literally earns uninterrupted compounding interest, and that is the sweet spot. And as you do this, as you become the bank, you make the spread, not their bank. Now, in the middle, you will see segregated account. That is a separate bank account. The only reason we use a separate bank account from someone else's bank is because of books and records. We want to clear our bank's money through their bank, so we have records of that money leaving our bank and then coming back into our bank. Don't overcomplicate that. So how does all of this work? Well, it works just like a bank does. So let me explain. All of you know how a traditional bank works. It's simple. You make money, you take the money you earn by trading hours for dollars or any of the various other ways you can make money, and you put it into their bank. Now you can see in the middle I crossed off their bank, but it's okay. You definitely put it into someone else's bank. And what do they do with it? Well, first off, they pay you interest on the money, right? They pay you some form of interest on the deposit you make in their bank. But then they immediately take your money, your deposit, and they lend that money out. They lend that money out to people to buy a house in the form of a mortgage. And when there's a mortgage issued and the bank issues that check goes to the seller of the house. The seller of the house takes the money from the house that they just sold and they put it back in the bank like they've always been taught. The bank takes that money, that deposit, and lends it back out to someone that wants to buy a car or a truck. And that car or truck is in the form of a car loan, and they put a lien on the truck, just like they put a lien on the house in the form of a mortgage. The car dealer or whoever sold the car gets the money and does what they've been taught, puts it right back in the bank. Then the bank immediately turns that money around and lends that money back out to someone doing a remodel on their house, maybe an addition, a bathroom, a kitchen. that money from that remodel goes to the contractors. The contractors do what they've always been told and put the money right back in the bank. The bank immediately lends that money out to someone that just got themselves in a little bit of debt, and that debt is called a debt consolidation loan. That pays the credit cards off, and the credit cards take the money and put it right back into, yes, you guessed it, the bank. And let's look at who controlled every one of those transactions in the traditional banking system. Was it you? Because it's your money, right? It was your hard-earned money that you trade hours for dollars for. No, it was the bank. The bank was in full control. And how much risk did the bank actually take lending your money out? Well, the answer is not much, because all of these loans, except for the debt consolidation loan, were all collateralized by real estate, a car, a second position on the real estate for the remodeling loan. And the debt consolidation loan was the one with the highest interest. Why? Because it involved the most amount of risk. So each time the bank lent your money out and our money out, they made a spread because they paid you interest on the money at a lower rate than what they charged you on that money. The bank makes your money work for them, and they make a spread. The difference between the interest they pay you and the interest they charge you for the loans you take. Now, in that example I just did, the traditional bank is in control. But if you are the bank, then you are in control and you make the spread. Hence, be your own bank. So, what is this machine that we're gonna put our money in? You know, that one change that you mentioned? Well, let me explain. That machine is nothing more than a specially designed and engineered whole life insurance policy from a mutually owned insurance company that pays dividends. Yeah, I know what you're saying. You're like, say what? I'm not putting my money in one of those whole life policies. All the gurus say that that's the worst place I can put money. However, let me explain to you why what you've heard about whole life may not be the whole truth. So like I said, you're gonna change one thing, and that's where your money goes first. And your money is gonna go into this specially designed and engineered whole life, but the whole life is designed and engineered different than a regular whole life policy. Because remember, we're not looking to buy life insurance. What we're looking to do is set up our own private banking system, right? Absolutely. So the first thing we got to understand is the money we're going to put into this specially designed whole life is going to be premium deposits. So we got to change our mindset, because when you put money in a bank, you make a deposit. So when we put money in our bank, that whole life policy, we are going to make premium deposits into the whole life contract. Now remember, I said it's a mutually owned life insurance company that pays dividends. That's very important. What you're doing is you are capitalizing the policy and creating your own banking system. Now, one thing that's very important to understand is when we do this, like I said, it's being designed and engineered. So that means that we're not going to just put the money in the regular base part of the whole life. We're going to put a majority of the money, a high percentage, into this separate pot of money held by the insurance company, and they call it PUA. Yes, PU, but that doesn't mean it stinks. That means paid up additions. Now from this pot of money, this is where we're going to take loans. When we need money, we can take money because this is our banking system, not theirs. There's no applications, nothing like that. Answer 3 or 4 questions on who's taking it. You don't need to tell them why you're taking the money, but you just need to tell them where it's going to go. You see, you own it, not the stockholders. Unlike a traditional bank, usually they're owned by stockholders, so they got lots of rules. But this policy, you own it. It's your contract. It's your banking system. You are the policy owner, which means you fully control it. Which also means when you want access to your money, all you need to do is take a loan from your policy. Now, when you take a loan, it's very important that you understand what taking a loan is. So now when you take a loan, you're actually going to take a loan from the insurance company's general account. But what the insurance company is going to actually do is they're going to give you some of your death benefit while you're living. That's right. We no longer need to wait for this guy, the Grim Reaper, to come and take you so that you can have the money going to your beneficiaries. No, no, no. What this is gonna do is we're gonna basically bypass this little bugger here. We don't need to wait for the Grim Reaper to get our money, because the insurance company will let us use our money early before we die, and all they're going to do is they're going to take that money from the general account and give it to us to use to do all the things we want to do with it, like those opportunities we spoke about. Now, when you take money from the death benefit, that money will be collateralized. That loan will be collateralized by the money you have in your policy, that paid up additions and also that premium deposit into the whole life contract. That money, your cash value, will collateralize the loan they give you from your death benefit. Now, the nice thing is, when you take a loan from the policy, that loan technically never needs to be paid back, because essentially they just subtracted it from your death benefit that has to be paid out the day you die. So there you have it. IBC explained. Hopefully that visual gives you a good understanding of how you can take back control of your wealth, and how, by taking back control of your wealth, allows you to be your own bank. I always say the most important thing that you need to do is control your money. But that isn't what society or the 95%ers will teach you. They will teach you to give up control so that they can make your money work for them. It's gotta stop. And it's got to stop right now. So hopefully you enjoyed this episode, and if you did, check this video out right here, BYO Bank.